Welcome to Jill on Money, powered by The Compound. I'm Jill Schlesinger, certified financial planner, all-around nice gal. I'm with Mark Talercio, my executive producer, also a certified financial planner.
You didn't call me all-around nice guy.
Well, you're not.
Yeah, most people would agree with that.
I was with somebody who likes you very much, our friend Beth, friend of the show, Beth,
yes.
who absolutely loves you. And you know what we were with another person, and she said, Mark is just an absolute doll. I said, which is what nobody ever says about him, except me.
That's why I love Beth.
I know. She loves you. Hey, you know what we're talking about today is a question that I said, I doubted you on this, Mark. I said, no, everyone knows this.
No.
And Mark says, no.
At least our audience, the answer is no.
So the question that Mark proposed for this segment was the difference between the S&P 500 index fund versus an extended market index fund.
And not necessarily the difference is it more along the lines is using one or the other the right way to go. And I would say it doesn't really matter.
Well, it can matter at times. This is one I want to be careful about. An extended market index usually includes more stocks in the whole in the holding, right?
So yeah, and I will just say, so if we're talking about the S&P 500, obviously that's the 500 biggest companies in America, large cap. Total stock market has a mix of large cap, mid cap, and small cap. So in theory, you're getting a broader range of things.
Right. And the thing about an extended market index is that maybe when you have large cap domination for a period of time, you're going to look at your holdings and you're going to naturally compare it to the S&P 500 because that's so broadly reported on. And you're going to say, why isn't my fund tracking the S&P 500? Right. And the real reason is that it is comprised of large, medium, small, growth value. So it's hard to show people the difference unless there's divergence. It just so happens that right now there's divergence. So, Mark, do you have a one versus the other?
Yeah, my family, my wife and I, we are 100% S&P.
Okay.
We do not use, and here's the reason. My wife wanted nothing to do with small caps. She just wouldn't allow it.
Oh.
She has her reasons, her thought process.
And she, by the way, she's an accountant consultant. She's super smart, way smarter than Mark.
So she doesn't like small caps. For whatever reason, I wasn't crazy about mid caps. So we just said, okay, we're just going to use the S&P and that's it.
I will tell you the real reason that I use the S&P, and I have owned Spiders, the SPY exchange traded fund, for so long that it has always been a dominant position. So I never went into a extended market index. I do have some small caps here and there, just like floating around. I don't know, like one day they will perform again, maybe-ish. I don't know when.
I think the whole, also another thing, the whole S&P 500 allocation picked up a lot of steam when it was several years ago. I think Warren Buffett put out a memo. And
yes, I remember.
Said, if I die, this is what I want my wife to be invested in.
Yeah, he said in his annual letter, heirs, here's what do not invest on your own and don't give anyone your money. Right. It was right after he won the Warren Buffett bet. Yeah. And where he bet a guy who ran a fund of funds that he could, so he said 90% S&P 500 index fund, 10% treasuries.
Yeah, or even like a total bond fund.
And that's it.
And a lot of people saw that, and I think that's where it picked up a lot of steam. And the other thing I will say, because, I do help out a lot of people with their financial plans and just kind of figuring out their 401ks. And a lot of people just have no idea how they're invested or what they're invested in. And I'll see a lot of allocations. There'll be like 40% in the S&P and then 20% in a total stock market index. And they don't realize that if you do that, that's just overlap. There's a lot of overlap there.
I think that in many people's accounts, especially in retirement accounts, what people will do, and this is like the little false step, you start with one allocation. Then you get spooked about something, you change it, or someone tells you, no, you should be in this fund, but you don't change your whole allocation. So what often occurs is people will add different funds without saying, okay, this is my allocation in the future. They don't do it to the existing holdings. So when you have a 401k, a 403b, a 457, a thrift savings plan, you should be looking at what funds you own and whether or not there is some duplication or overlap. So don't be owning a large cap growth and the S&P 500. They're essentially the same. You don't need to worry about it. And chances are that growth fund is managed and costs money.
And don't own the S&P and the total stock market index fund and the target date fund. That's just a lot of overlap.
Yeah, and just a word on target date funds. I think in a target date fund, the other piece of this is to be careful that you are either using a target date fund or you're allocating yourself.
Yes.
You don't need to
Don't
do
both.
It's
Don't do
just,
both.
it's unnecessary. Okay, so you don't like small caps, you don't like mid caps, you like the S&P 500.
And that's just me. If you're out there,
that's not advice. That is not investment
if
advice.
you're out there and you own the total stock market, stay with it. That's totally fine.
And is there any other follow-up question that you need to make sure that we communicate?
No, it's similar to what we did in a recent episode, where, ETF versus index fund. S&P 500 total stock market index fund. You're not going to go wrong either way. Don't sweat it. It's just kind of a matter of personal preference. Some people will insist that you have to have small caps and mid caps. I'm just not one.
Yeah, I mean, look, there's no insistence and there are no rules of thumb. Do you know what the rule of thumb is? Contribute to your plan.
Yes.
Capture the match. Don't think you can outsmart the market. You can't. Be careful with your trading. And rebalance. And, if it's a retirement account, you can rebalance every quarter if you want. There's usually a little box you can check. If it is an investment account, once a year, gang, once a year for that rebalancing. That's all you need. And we're going to be doing a nice episode on tax loss harvesting. So we'll get into that. But for today, I think we've got that covered, right? We're good?
We're good. Either way, you're not going to go wrong. Just use one or the other.
One or the other. And if you have a question, go to jillonmoney.com, click the Contact Us button. We'll walk you through your allocation. We'll look at the funds you have. And by the way, the expenses of an extended market index and an S&P 500 index are virtually the same. Once you start diving into a lot of these other funds, you might be adding a lot of costs that is unnecessary. But if you want some help, we are here to help you. Again, jillonmoney.com, click the Contact Us button, write us a note, and we will help you happily. So thank you so much for watching, and we'll chat with you next time.